Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Christine Benz examines the implications this market could have on retirees. Josh Aguilar points out a stock with a consistent, predictable dividend. Christine Benz shares 5 investing missteps investors might make while navigating volatile markets. Christine Benz reminds us what to consider while looking for the right asset allocation for our portfolios. And Vanguard's Maria Bruno addresses the decisions young investors face. Let's get started. Susan Jabinski and Christine Benz from Morningstar Inc. examine the implications this market could have on retirees.
Hi, I'm Susan Jabinski with Morningstar.com. What are the implications of this market for retirees? Joining me today to discuss that is Christine Benz. Christine is Morningstar's Director of Personal Finance. Christine, thank you for joining us today.
Susan, it's great to be here.
Now, Christine, you and our colleague, Jeff Tack, recently interviewed retirement researcher Wade Pfau for your Longview podcast, and he had some sobering conclusions for some of the research he's been doing.
He did, and granted, we talked to Wade back in March, I believe, or maybe early April. Anyway, things were feeling even more uncertain than they are today, but he was less bothered by what we were seeing in the equity market and more concerned from a retirement planning standpoint about the prospect of ultra low yields and the implications for retiree plans. That's really what he pointed to as being a potential key sticking point for retiree plans going forward if they just sort of accept the conventional wisdom about how to approach plans.
So let's unpack that a little bit. So then what are the implications for retirees in this very low yield or no yield environment?
Well, the starting point, because bond and cash yields are so low, is that he believes, and I think it's good advice, that retirees ought to take a look at their withdrawal rates, or if they're pre-retirees embarking on retirement, to really think hard about the 4% guideline or rule that's very much in play in retirement planning circles. He believes that that number is too high, that new retirees ought to think about trying to subsist on a lower number. He thinks 3% may be better. In fact, he co-authored a research paper a few years back with our colleague David Blanchett that made a big splash, arguing just that because of low yields, because they're likely to stick around for a while, that new retirees should think about a lower starting withdrawal rate. Alternatively, we discussed some variable withdrawal rate strategies, which are also a possibility. In fact, some of the retirement research points to those being better than sort of taking out, say, 3% in year one of retirement and then inflation adjusting that dollar amount from there. So there's a lot of research that's been done in that space about variable withdrawal rates. Some of those strategies might be effective in such an environment as well.
And so what did he have to say about those investors who are already in retirement? So not just entering retirement, but have been in it for a while. What are the implications for them? What should they be thinking about?
I think they have reason to feel a little better. And the reason is that they have successfully avoided the big worry that retirement researchers think about, which is what's called sequence of return risk. And that basically means that you encounter a lousy string of returns early on in your retirement that has the potential to permanently impair the portfolio so that it never quite recovers. The good news for people who have been retired for many years is that they've successfully circumvented sequence of return risk. They've made it through if they've been retired for 10 or 15 years or whatever it is. And so they have less to worry about from the standpoint of market returns potentially not being so good over the next decade. They should still take a look at their withdrawal rate, make sure that it looks sustainable, but they're probably in better shape than new retirees or people who expect to retire within the next couple of years.
Christine, another topic that came up in your conversation with Dr. Pfau is this idea of buffer assets. Can you sort of unpack that concept for us? Let us know what they are.
Yeah, I love this idea. The basic idea is that you have some assets in your plan that you could draw upon if your portfolio drops. And so, a really simple example, one that I talk about in relation to the bucket strategy, is just having cash on hand to tide you through a low yield period or a period in which equities are down. That's one example, a very simple example of a buffer asset. He mentioned a couple of others that I think are worthy of consideration. One would be cash value of a life insurance policy for people who are retired and still have a whole life insurance policy. They may be able to tap that cash in a crunch. He also talked about standby reverse mortgages. So you might be able to tap the equity in your home through one of those reverse mortgages if your portfolio is down and you don't want to invade the assets during a period when equities are down and perhaps when bond yields aren't supporting your cash flow needs.
Now, Christine, you've also written about plenty of other strategies that retirees might be thinking about in this low yield environment. Let's talk a little bit about some of those.
Yeah, talking to Wade really got me thinking about some of the knock-on effects from low yields in relation to other aspects of retiree plans. So one thing to think about is the role of Social Security, the date at which you might file for Social Security. As people who are even casually interested in retirement planning know, you do pick up a little bit of an extra benefit from delaying Social Security past your full retirement age. And so it's worthwhile to take a look at that because that is sort of a guaranteed bump up in your eventual benefit. When you're looking at guaranteed returns on other safe parts of your portfolio, that return enhancement, if you might call it that, looks even better. So if you haven't yet filed for Social Security, maybe thinking about that. Also looking at mortgage pay down. I think that people who are getting close to retirement who have even a very low interest rate on their mortgages might look at that, especially if they have safe assets in their portfolios that are earning next to nothing. Paying down that mortgage may in fact be a better use of funds. So I think it's important to look at your plan in totality, not just focus on the portfolio piece.
Christine, thank you so much for your thoughtful commentary today on rethinking retirement income. We appreciate it.
Thank you, Susan.
I'm Susan Jabinski from Morningstar.com. Thank you for tuning in.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit Morningstar.com/Alexa. Now, Josh Aguilar from Morningstar Research Services highlights a stock with a consistent, predictable dividend.
Multi-industrial stocks are generally safe havens for investors seeking consistent and predictable dividends. 5 multi-industrial stocks have paid an annually increasing dividend for over 60 years. We cover 4 in 3M, Dover, Emerson Electric, and Parker Hannifin. There are several reasons for this consistent dividend-paying dynamic. First, most of these so-called dividend aristocrats are broadly diversified in multiple different end markets. So a company may have exposure to weak end markets at any given time, like aerospace and oil and gas. They typically also minimize their downside protection by positioning themselves to more stable end markets. Second, these firms also generally sell mission-critical products and services in a business-to-business setting, which arguably positions them better relative to consumer-facing stocks for when the economy does recover. A lot of these companies use a razor blade strategy, meaning they build a large installed base of equipment to earn years of higher margin aftermarket revenue, which can last several decades into the future. Third, the U.S. multi-industry stocks we cover are also generally good at managing their free cash flow. Many of these management teams can prepare for a downturn by reducing inventory and more aggressively collecting receivables, as well as extending payables in a downturn. Finally, high-growth value-accretive internal investments are generally going to be less frequently occurring relative to what you might see in a technology company. So many of these companies are going to look to return capital to shareholders in the form of a dividend. We really haven't been concerned with any of these companies cutting their dividend payments because of their current financial pressure. What you might expect to see is suspension of share repurchases in a downturn given the uncertain environment, cutting down CapEx to maintenance levels, as well as minimal increases to a dividend relative to what you might see during good times. As for an individual name we like, we point investors to Eaton Corporation. The 4-star rated stock currently trades at a 22% discount to our fair value estimate. From a total returns perspective, over the next 5 years, on average, we think investors can expect about a 9% to 10% range of EPS growth, along with what's currently a 4% dividend and some share repurchases to boot. We like its positioning in the electrical sector market, and we think it's a smart play on industrial infrastructure spending. We think the market's missing 2 key points in its valuation. One, we think investors aren't crediting the firm with fundamental improvements to decremental margins. And second, we're confident that the deal and the sale of its hydraulics business to Danfoss will close, and we think this is a catalyst in the stock that the market's missing, particularly since this is cash that Eaton can use to return to shareholders.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Christine Benz shares 5 investing missteps investors might make while navigating volatile markets.
Hi, I'm Susan Jabinski with Morningstar.com. The market seems to have regained some of its footing, but there are still plenty of landmines out there for investors. Here today to discuss a few of them is Christine Benz. Christine is Morningstar's Director of Personal Finance. Christine, thank you for joining us today.
Susan, it's my pleasure.
Now, the first mistake that investors might be making in today's market is assuming that the worst is over.
I think that's a big risk for investors right now. We have had such a tremendous recovery in stocks since they bottomed in March that I think it might be tempting to assume that it'll be sort of off to the races from here. And I think the big risk in that is that there's just still so much uncertainty out there in terms of the economy, in terms of what shape the recovery will take. And so I think investors would want to be careful at this juncture about really backing up the truck for equities. Which is not to say you shouldn't have equities. You absolutely should. You need the growth potential that comes along with them. But if you are someone who is getting close to retirement, if you're, say, within 10 years of your expected retirement date, I think it does mean that you want to take care to make sure that you have enough dedicated to safe assets like cash, like bonds.
Now, another mistake that investors could make is sort of the opposite of that, is becoming too defensive.
That's right. And I think that might be tempting right now. As I said, there is so much uncertainty currently. And investors sometimes are tempted by these tactical asset allocation shifts, especially when you go through the sort of wrenching downturn that we experienced in March. But one thing I often point to is the fact that we've got this universe of tactical asset allocation mutual funds. As a group, they haven't made a particularly good case for themselves. That, to me, suggests that we individual investors might not be able to do a lot better. And then the other thing that I would point to is when you look at safe investments, which you do absolutely need if you're close to retirement or retired, when you look at the yields on safe investments today, they're really, really low. And that suggests that the return that you're apt to earn from them is very low as well. So you certainly wouldn't want to hunker down in an all-defensive portfolio because you might not even beat inflation over time with such a portfolio.
Another mistake that investors might be likely to make in an uncertain market is to want to add complexity or overcomplicate their portfolios. How would you define that, and what do you think of that?
Well, one product type that is often heavily marketed during periods like this would be alternative investment funds, and there are increasingly liquid versions of these, and these are like hedge fund type products. When we look at the performance of these funds, and it's a big tent, there are lots of different variations, but what you see is that by and large, these funds haven't distinguished themselves particularly well, even in periods when you might expect them to. And granted, we may see more opportunities for them to distinguish themselves in the months ahead, but overall, this is a high cost group of products. It's hard for me me to see how you would gain a lot relative to an appropriately diversified, very vanilla stock and bond portfolio. There's certainly a diversity of opinion about these products within Morningstar. There are some of our analysts who like them quite a bit. I'm less of a believer. I think most investors can obtain adequate diversification with very vanilla building blocks.
Another mistake that investors can make, and that you've been talking about quite a bit in your work during this market upheaval, has been the idea of not making radical bets or radical shifts in your portfolio during periods of market duress. Can you talk a little bit about what you view as a radical bet or radical shift?
Right. So we've talked about some of the broad asset allocation shifts that investors might be tempted to engage in. I would put those in that category, but also intra-asset class bets. So right now, if you read the financial press, you see a lot of chatter about value stocks, when value stocks might be ready to recover. I think it might be really tempting to take your whole portfolio and sink it into value stocks. Alternatively, you hear the opposite narrative that some of these large cap tech names that have been pacing the market, that those are the place to be for the foreseeable future. I think you just really want to resist that sort of all or nothing mentality, especially when things are as uncertain as they are currently. Diversification is so much your friend. So you want exposure to both security types. Certainly if you have a broad-based index fund, for example, you're getting small value stocks, you're also getting some of the large growth stocks. I think that's a better way to play it rather than betting too narrowly.
And our last mistake that we wanted to talk about today was sort of a sin of omission or a missed opportunity. What is it?
Yeah, this is just an opportunity to really think about your financial plan. And certainly there are some people who find themselves quite time pressed through this quarantine that we're all experiencing. But some of us do have a little bit extra home time, a little bit more time to kind of just think about the big picture. So I think it's a good opportunity to check in on the totality of your plan, your proximity to your goals, and really what your goals are. Not just, I want to have $1.5 million for retirement or whatever that goal might be, but just to think about life goals and how they intersect with your financial plan. If you have some extra time to think about that, to maybe have some of those discussions with your spouse, I think this is a great time to do so.
Christine, thank you so much for your time today. As always, these are wonderful insights and some things that we investors mistakes we should be trying to avoid during these times.
Thank you, Susan.
For Morningstar.com, I'm Susan Jabinski. Thank you for tuning in.
Now, Christine reminds us what to consider while looking for the right asset allocation for our portfolios.
Hi, I'm Christine Benz from Morningstar.com. Many investors are stumped by the question of how to allocate their portfolio's assets, dividing them between ultra-safe cash, higher returning but higher risk stocks, and bonds, which occupy kind of a middle ground. The right answer can seem kind of black boxy, but I think it's helpful to take a step back and consider your spending horizon and the likelihood of having a positive return over that specific time frame. For money you expect to need in the next couple of years, it's wise to just park it in cash, whether that's CDs, a checking account, or a money market account. Returns are really low, but cash is the only asset class where your money is guaranteed. If you have a slightly longer time horizon, say 3 years or more, you can invest in high-quality bonds or a high-quality bond fund. You're taking more risk, certainly, but you'll have the potential for higher returns than you can earn with cash. Finally, if you have a longer time horizon for your money, you should opt for the highest returning asset class you can find, and that's stocks. Stocks have actually been reliably positive for people who have time horizons of 10 years or more. But over shorter time frames, their returns have been more erratic. Young investors with no imminent need to spend their money absolutely should have more in stocks, whereas investors getting close to retirement will want to earmark more for cash and bonds. Thanks for watching. I'm Christine Benz from Morningstar.com.
Expand your investing horizons and look to the long view with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance Search for and subscribe to The Long View today. And lastly, Vanguard's Maria Bruno addresses the decisions young investors face.
Hi, I'm Christine Benz from Morningstar. Younger investors still have a long runway to retirement, but they have to balance that long-term goal against shorter-term objectives like buying homes and paying down debt. Joining me to share some strategies for younger investors just getting their plans off the ground is Maria Bruno. She's head of U.S. Wealth Planning Research at Vanguard. Maria, thank you so much for being here.
Thank you. Good to be here.
We talk a lot about retarees, you and me, but I'd like to talk about the younger set, people who are just kind of getting their plans up and running, maybe have that first job. So let's kind of start at the top of the pyramid, what is most important for folks at this life stage. And that's really kind of balancing competing priorities. You've got a lot of folks coming out of college with significant amounts of debt. They know they should get started on retirement planning. They know they should have an emergency fund. So how do they figure out where to deploy their money?
Yeah, I think you nailed that. That's the big one. It's resource allocation
Right.
in terms of, well, how do I invest my next dollar, if you will, across these different options? So, I think it's fairly straightforward, but it can seem overwhelming. First, you want to think about what are my high return type opportunities? And at the forefront of that, I would put, if you have a 401k with an employer match, for instance, an employer plan where the company matches, certainly that should be your first source, because if you give that up, then you're basically leaving money on the table. That's 100% return right there. So that's the easy one. From there, then, you might want to think about what type of debt, or if I'm dealing with some high consumer type debt that has a high interest rate, that might be the next place that you want to look at in terms of paring that down. So those would be probably the top two. Then you want to think about emergency savings. Do I have that rainy day fund in case of an emergency? And I'd like to spend a little bit of time on that, because when you think about what this emergency savings looks like, a conventional rule of thumb has been 3 to 6 months worth of living expenses in a cash account. Well, that may not be the best thing for a young investor, given limited resources. One way to think about it might be, a spending shock. So if something were to happen, maybe if the car breaks down, or
big vet bill, or
yes, something like that. Yes. Do I have liquid cash to pay those expenses? And maybe there you're talking a half a month to a month worth of expenses. And then the other thing would be a loss of income shock. So what would happen if I lost my job? Do I have enough to live off of? And those are probably more accounts that are marketable. So money you have access to, but not necessarily sitting in cash. And one avenue I'd like to explore there is a Roth IRA, for instance. We talk about this a lot as well. The contributions that you would make to a Roth IRA are after tax, so the money's already been taxed, but you can access those contributions income tax-free and penalty-free. So you can think about that as something up your sleeve if you need to then access some relatively quick money. Certainly you want to preserve that for retirement, but it is a multitasking type of account. I think you've used that word in the past as well, in terms of being able to be there in case you need it.
Okay, so I'm thinking of that as kind of my income shock fund. If in a worst case scenario I lose my job and I stay out of my job for a while, that Roth IRA, tapping my contributions tax-free and penalty-free, might be a pretty good way to go.
Yeah, so and what's nice about that too is, hey, you're setting the retirement clock already, but that money then there is if you need it. And certainly you can save in a non-retirement account as well. What I like about the Roth is that it offers tax-free growth versus a taxable account that grows, potentially, but at cap gains tax rates. So there's a little bit of a difference there. But certainly non-retirement taxable monies are prudent as well. And then from there, you really want to think about the other sources. And there, I would say balancing down debt with also saving for retirement as well. Or you might have other goals. So balance, it's not all or nothing, but it's a little bit of a seesaw in terms of balancing those two types of goals.
Okay, so you referenced Roth IRAs, very attractive from the standpoint of flexibility and being able to pull those contributions if in a worst case scenario you need them. But how about that sort of fork in the road if I'm contributing to my employer plan and I have the traditional 401k, make the pre-tax contributions, and I also have the Roth 401k where I can make after-tax contributions. How should people approach that decision?
Well, that's a good question. So for younger investors, if their plan sponsor offers the Roth option, not everyone does, but we're seeing an increasingly higher number of plan sponsors offering that option. Young investors might want to consider that in terms of their deferrals for their contributions. And the reason is, when you're young, you're most likely in a lower tax bracket than you will be later. So the key then is, when do you pay tax on those monies? You want to do that when you're in a relatively lower tax bracket. And for young investors, the value of the tax deduction that they might get with the contributions in a traditional deferred account are probably far outweighed by the tax-free growth that they would get with the Roth over those number of years of compounding. So that's very attractive. We talk about tax diversification for investors and holding different account types. With a 401k, you may direct your contributions to a Roth, but your company match must go into the traditional deferred account. So right off the bat, you get tax diversification right there. So that's a nice feature as well.
Okay, so another vehicle that might come into play would be a health savings account if you're covered by a high deductible health care plan, which is increasingly common. How should younger folks think about funding those HSAs?
Right, so healthcare is needed, for all of us. So what's nice about the HSA plan, so as you mentioned, you have to have a high deductible healthcare plan. It offers the health savings account. The premiums are typically lower. There might be a higher out of pocket. However, there are caps on that amount as well. But that money is unique in that it's got triple tax benefits. So you make the contributions with pre-tax dollars. The account grows tax deferred, and then when you pull that money out for healthcare reasons, it's tax-free. So it's a very attractive tax vehicle, and you can almost think about it as a retirement savings vehicle if you have the means to do so.
Right.
That would probably be the rosiest of situations in terms of, hey, I'm going to put money into this account, and I may have other monies that I may use for my healthcare expenses if I were to incur them. The reality of it is, many young investors or those with limited means may not be able to do that. But even putting the monies into the health savings account, you're taking advantage of the tax benefit because the monies are made with pre-tax dollars and then tax-free distributions.
So even if my plan is to use my HSA just as a basic kind of spend-as-I-go vehicle, it's still wise to run it through the HSA and pick up those tax benefits?
Yes, I mean, it can be. Absolutely, it can be. That's more of a transactional type of account. Now, the thing I will say is, you want to look in terms of what type of investment options do you have within your health savings account, and just make sure you understand how, what the plan offers, what the cost of those investments might be, and make your choice there as well.
Okay, Maria, always great to get your perspective. Thank you so much for being here.
Thank you. Good to be here.
Thanks for watching. I'm Christine Benz for Morningstar.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.